Hey, good morning once again, options traders. Well, as I mentioned in the last video, I wanted to do a series over the next several videos on different perspectives for different strategies. And I decided to do this because I've had conversations with traders, and when you start hearing their reasons for putting the trades on, you find that many of the times they're completely off in left field. And they're doing strategies for usually exactly the wrong reasons. So another popular strategy with traders is a calendar spread, also called a time spread. So let's go find out the real reason for doing a calendar spread. As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and definitely helps to promote the channel. So first off, what is a calendar spread? Many of you know it, many of you don't. Let's take a closer look at what this strategy is. You're going to use either two calls or two puts, not one of each. You're going to buy a longer dated option and you will sell a shorter dated option with the same strikes. So that's the key. You're buying the longer dated one, selling the shorter dated one with the same strikes. So what you're spreading off or separating are the months. And this would be a long calendar. In other words, that you own it. It would be a debit spread. Because remember, all things being equal, longer dated options cost more money. So to buy a calendar spread will absolutely be a debit. So for example, let's say that you buy the March $100 call and you sell the January $100 call. Notice we have the same strikes, but we're long the longer dated option. So if you think about it, it's kind of odd. We have the right to buy shares at 100, but we have the obligation to sell shares at 100. There's no real benefit just looking at those strikes and going back to our rights and obligations. The benefit comes in from the rates of decay, and that the shorter term option is going to decay faster than the longer term. That's really what we're after. And so before we put on a calendar spread, we need to see if there's some type of a violation with these pricing principles. So this trade right here would look like this. In black would be our expiration graph. Now we have to be careful when we're talking about calendar spreads or diagonal spreads where we have different expirations. Normally our risk graphs, the one in black, means that all options expire at the same time, such as for vertical spreads or a condor, butterflies, stuff like that. But when we're dealing with calendars and diagonal spreads, that's no longer true. So when you see the expiration graph, it's really at expiration of the shorter term option. And that's why we don't get the straight lines through here like we do for most of the other risk graphs. Now the curve in red, remember, is the current curve. That's what our profit and losses look like today. Over time, the center will start to rise higher and the wings will push lower. So we'd like to see the stock stay in the middle. And this is where traders start to have misperceptions. They'll say, oh, I get it. You want to use a calendar spread because you think the stock is going to stay neutral. It's going to stay in a fairly narrow range. That's a really bad idea for using a calendar spread. Again, there's no real reason to put on any strategy unless you have some type of an edge. Now, many of the times it's going to be a perceived edge, such as with implied volatilities, things that look like it might be a pricing discrepancy, but we won't really know until expiration. But with the calendar spreads, we do know. And that's really the reason that this strategy was developed. So why should you trade calendars? Well, again, it's because of pricing discrepancies. That is really the main reason for doing a calendar. So remember, there's no reason to take a trade without an edge. Don't trade a calendar just because you think the stock's price will remain neutral. If you have a huge edge against you, it's a bad trade. It doesn't matter what you think. If the odds are stacked against you, it's not a good trade. So you can see that it's a bad perspective to say, oh, I want to trade a calendar because I think the stock is going to sit still. All right, so what is this pricing discrepancy that we're talking about? Well, we've talked about it so many times before, the square root pricing rule. And what this says is that it takes about 4 times the amount of time to double an option's price. This applies to at-the-money options only, which will usually be the strikes you're using for a calendar spread. So here's what this pricing rule means. If we have a 1-month option trading for $1, what's a 4-month option worth? Most traders are going to jump and say it's worth $4 because we have 4 times the amount of time. Well, it sounds logical, but it's not the way that option pricing works. Here's what we have to do. We look and we notice that there is a 4-fold difference between these two options. Now, in the real world, it's probably not going to work out that clean and neat. You might have one that has 32 days and another one that has 126 days, but just divide them out. And you're going to get some kind of a ratio. So in this case, we know the second option has 4 times the amount of time. We take the square root of 4, and that of course gives us 2. Now we have our multiplier for the right side with the prices. If the first option is trading for $1, the second option should be trading for 2 times that amount. But notice it's not because it has twice the amount of time, it's because it has 4 times the amount of time. So we would expect that this 4-month option should be trading for $2. Now, if this first option were trading for 3, we would expect this one to be trading for 6. So that's the way that the pricing relationships work. Now, if we see this pricing relationship coming in exactly like this, or at least within a few pennies, we would say that that is trading at fair value. And in a case like this, there's no real reason to trade the calendar spread. No reason not to, but there's no reason to do it. You don't really have an expected edge. But do you see what a different perspective it is now? It's not because I think the stock is sitting still. It's because there's no real edge and therefore no real reason to trade the calendar. So where might we see an opportunity? So for example, let's say that we see a 1-month option trading for $5 and we are planning on buying the 9-month option and selling the 1-month option. Well, what's the 9-month option worth, or what should we expect to see it trading for? Well, again, we divide these out. We see that there is 9 times the amount of time in this longer dated option. Square root of 9 is 3. And so we know that the multiplier over here is 3. The 9-month option we would expect to be trading for 15. So in this instance, no reason to really take the calendar. But what if the 9-month option is trading for 14? See, it's a relative difference. I can't really say if the 9-month option is cheap or if the 1-month option is expensive, because I could also make an argument and say that this should be 1/3 of 14. All we know is that relative to each other, that the 9-month option is cheap. So in this case, sure, buy the calendar. That would be a reason for buying the calendar. But what if we saw that the 9-month option was 16? Now, from a relative standpoint, the 9-month option is expensive. Or we could say the 1-month option is cheap. So again, we don't really know which one is expensive and which one is cheap. We just know that relative to each other, we'd rather sell the 9-month and buy the 1-month. So this would be an opportunity to perhaps do a short calendar, and you would therefore have an edge in your favor. So the main thing to take from this is that you don't want to put on a strategy just because of what you think. I've often made the analogy like with football bets. Doesn't matter if you think your team is going to win if there's a 21-point spread against them at Vegas. It doesn't make it a good bet. And you have to have that same mindset when you're trading options, and especially with calendar spreads. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis class. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.